Okay, today we're tackling a really fascinating piece of financial history. We're looking at Markel Group's 2008 shareholder letter.
Right. 2008, what a year.
Exactly. A total financial storm, unlike anything most of us had seen.
Yeah.
And this letter, it really shows how one company navigated that with incredible resilience and a very disciplined strategy.
Hmm.
So our mission for this deep dive is really to explore what Markel actually did. What can we learn about staying calm, investing smartly, and adapting when everything seems to be falling apart?
And the source material itself is quite revealing.
It really is. We're pulling directly from excerpts of their 2008 annual report. It's remarkably open, very transparent, coming straight from Markel's leadership.
Mm.
We've also got some guided questions to sort of frame things. You should expect some surprising insights here.
Definitely some enduring wisdom in there.
So let's set the scene first. 2008, I mean, a global economy was just imploding. People were calling it the worst financial crisis since the Great Depression.
Absolutely. Chaos doesn't quite cover it.
And Markel's leadership, they were incredibly candid. They admitted the year was disappointing, even poor.
They even suggested some might call it disastrous or their worst year ever.
Yeah, but then they added this twist, calling it an opportunity, which is striking.
It really is. That candor, especially when you look at how they actually performed relative to everyone else, it's quite something.
Oh, okay, so talk about that relative performance. They admitted it was tough, but how did they actually stack up?
Well, they certainly didn't hit their internal targets, no question. But acknowledging the sheer difficulty, that was different from many others who were maybe downplaying things.
Right.
Their actual numbers showed a decline, but it needs context. Book value per share, it dropped 16% to $222.20.
Okay, 16% down.
Yeah, but that followed a period where they'd seen 10% compound annual growth over the previous 5 years. So that 16% drop, while, significant, wasn't quite the catastrophe it might sound like in isolation.
So what's the crucial context then? How do they do against the wider market?
Well, think about the insurance side first. Even with insurance prices falling and a major hurricane hitting Houston.
Hurricane Ike, right.
Like, yeah, they still reported a 99% combined ratio for the year.
99%. So basically break even on the underwriting.
Pretty much. For every dollar in premiums, 99 cents went out for claims and costs. In that kind of environment, just achieving near break even on underwriting, that speaks volumes about their discipline.
Okay, but what about investments? That's where the real carnage was happening.
Oh, absolutely. Their equity portfolio got hammered, down 34%. They had over $400 million in realized investment losses.
Ouch.
Big ouch. But, and this is the kicker, even with that huge hit, Markel still outperformed the S&P 500 index
They outperformed the S&P.
in 2008.
They did. And they finished the year with low financial leverage. They actually got senior debt rating upgrades from 2 agencies, and they were sitting on $1.1 billion in cash and short-term investments.
And you compare that to, say, AIG, Citigroup, Bank of America, giants needing massive bailouts.
Exactly. Markel ended 2008 in a fundamentally stronger position. So this really begs the question, right? How did they manage that? What were they doing differently?
Well, it really starts with their core business, specialty insurance. Their goal, year in and year out, is consistent underwriting profit. They aim for combined ratios in the low 90s, ideally better.
To get reasonable returns on capital.
Precisely. So achieving 99% in 2008, they called it a modest success, which, given the circumstances, feels like an understatement.
Modest success, yeah. And that included the hurricane losses.
It did. $95 million from Hurricanes Ike and Gustav. That alone added almost 5 points to their combined ratio. But even that was $20 million better than their first estimates after the storms hit.
So they were refining their loss estimates effectively.
And the letter explicitly mentions that the underwriting changes they made after Hurricane Katrina were working. It shows they were learning and adapting.
Okay, so core underwriting discipline held firm. But the insurance market itself was under pressure, right? Rates were falling.
Oh, absolutely. Prices had been declining for several years, and 2008 just continued that trend. Rates had dropped so low, just holding steady wasn't enough. They were getting close to unsustainable levels for the industry.
And this is where Markel makes this, I mean, it seems like a really bold move. Q4 2008, they tell their underwriters, stop cutting rates.
Right. Stop the decreases.
And then they followed up with targeted increases for most lines. They knew it could hurt their premium volume short term.
They acknowledged that risk.
But they said, and this quote is powerful, inadequate pricing will get an insurance company in trouble much faster than losing premium volume.
That's discipline personified, isn't it? Especially when competitors were likely scrambling for any business they could get, probably cutting prices.
So what did that signal, internally and externally?
It signaled an absolute unwavering focus on underwriting profit over just writing business, long-term health over short-term market share gains.
And how did that play out across their different divisions?
Well, their U.S. operations, like Markel Shand and Markel Essex, actually delivered solid underwriting profits. But some others struggled. Markel Underwriting Managers and Markel International reported losses.
Why was that?
Intense price competition, mainly. And they had some specific issues with the medical malpractice book in Europe. This forced some tough calls.
Like closing units?
Exactly. They shut down their global marine and energy unit in Houston. And they exited the medical malpractice business at Markel International because it just wasn't gaining traction or profitability like their U.S. businesses.
So connecting the dots,
Mhm.
even amidst the crisis, they were trimming unprofitable ventures.
Absolutely. It demonstrates that deep commitment to profitable growth, not just growth for growth's sake, value over volume.
Okay, so insurance operations.
Yeah.
Disciplined, holding firm. Now the investment side, as you said, total chaos globally. We saw huge names just vanish or need government lifelines. Fannie, Freddie, Bear Stearns, Lehman.
Wachovia, AIG, WAMU, Merrill Lynch.
Even blue chips like Citi, Goldman, Morgan Stanley, BofA were reeling. How did Markel's investment approach, which is often seen as a big different, hold up?
Well, first, again, the humility. They straight up said, while we were nervous and cautious a year ago, in hindsight, we were not nervous enough. They admitted they didn't foresee the sheer scale of the crash.
Fair enough. Not many did.
Right. But their underlying philosophy helped. It's value-oriented, patient. They stuck to a high-quality, pretty straightforward, plain vanilla fixed income portfolio.
So no complex derivatives or subprime stuff.
Exactly. They consciously avoided all that, and that helped them sidestep the first big wave of credit problems back in 2007. That was a huge advantage going into '08.
But even so, when the whole market imploded, they couldn't avoid it entirely.
No, definitely not. They took permanent losses on debt from Lehman, WAMU, Fannie, Freddie, and on equities like Citigroup, MBIA, Land America.
So what were the final investment numbers for '08?
Fixed income eked out a tiny positive return, 0.2%, just barely above water. But equities, as we said, down 34%. Overall, the entire investment portfolio fell 9.6% for the year,
Which they called.
their worst total return performance in Markel's history, period.
Yet despite that historically bad year on the investment front, they were still talking about long-term optimism, saying mark-to-market losses might be temporary. How?
It comes back to their understanding of history and cycles. The letter actually draws parallels to the 1920s. It talks about the mother of all bubbles fueled by debt and low rates over the prior 20 years.
So they saw it as an inevitable correction.
Yes, and they anticipated a long adjustment period with slower economic activity. That informed their actions. They'd already started getting defensive in 2007.
How so?
They cut their equity exposure way down. It was over 75% at the end of 2006, but by the end of 2008, it was down to 49%.
And they boosted cash.
Massively, from about $529 million to $1.1 billion by the end of '08. And ironically, cash ended up being their best performing investment that year.
It's just wild that they acknowledge, quote, pure, unadulterated panic would have been the best investment approach to take in 2008.
Right, but then they immediately pivot.
Saying you can't rely on panic as a long-term strategy. Instead, it's about humility, measured steps, consistency. That word panic in a shareholder letter. I mean, what did that feel like on the ground back then? Can you paint that picture?
Oh, it was visceral. Credit markets totally frozen. You had these century-old institutions just disappearing overnight. Every headline felt like the end of the world. The fear was palpable, even among really experienced professionals.
So for Markel to even say that word.
It showed incredible transparency, and it highlighted their core belief. Even when raw emotion seems like the right short-term reaction, you have to stick to a rational, patient process for the long haul. You just don't see companies talking that honestly very often. It speaks volumes about their culture.
Okay, so they're fighting fires on the insurance front, taking huge hits on investments. But they weren't just like frozen in the headlights. They were actually reshaping the company during the crisis. This One Markel initiative.
That's right. They took what they called their Atlas project and evolved it into One Markel. It wasn't just defense, it was offense for the future.
What was the main idea behind One Markel?
Basically, getting closer to their customers. offering the full range of Markel products more easily, making it simpler to do business with them, spotting opportunities faster, providing better solutions all through a single point of contact via new regional teams.
Streamlining and improving customer engagement.
Exactly. It was a proactive move, anticipating what the market would need after the crisis settled down.
And this meant big structural changes, leadership changes too.
Yes, significant ones. They reorganized 4 of their wholesale business units into a regional structure: Northeast, Southeast, Midwest, Mid-Southwest. That was rolling out by spring 2009.
They even piloted one office early.
Yeah, the Mid-South office in Dallas opened early, sort of as a test bed to iron out the kinks. And crucially, they set up a central product line group.
What did that group do?
They handled the core underwriting stuff, guidelines, pricing, program design. That freed up the regional teams to really focus on service, marketing, building those customer relationships.
Separating the what from the how.
Kinda, yeah. And then the leadership shifted to support this. Tony Markel moved from president to vice chairman. Paul Springman became president and COO, really driving that one Markel transition.
And others moved into key roles too.
Right. Jerry Albanese took over as chief underwriting officer. William Stoven became president of Markel International. Britt Glisson became chief administrative officer. And they brought in Mike Crowley to head up the specialty program division.
It's just fascinating that they undertook this major reorganization, this leadership shuffle, right in the middle of the worst financial crisis in decades.
It really is. It shows they weren't just reacting. They were proactively evolving to meet new challenges and, importantly, to seize opportunities they saw coming out of the turmoil.
It wasn't just about survival. It was about setting up for future success.
That's classic Markel, embodying their Markel style, consistent underwriting focus, value investing, empowering their people. That consistent value system was their anchor, letting them navigate these cycles and always look ahead.
Speaking of looking ahead, let's circle back to those price increases. It still seems so counterintuitive. Pushing for higher rates when the economy's tanking and competitors are probably desperate. Was there pushback internally, do you think? Or was the conviction just that strong?
From everything in the letter, the conviction seems unwavering, rooted in cold, hard logic. They gave 4 key reasons.
Okay, what were they?
First, just market reality. Prices had fallen for years. They argued there was basically no room to move any lower. Rates had to go up to be sustainable.
Makes sense. Reason 2.
Economic impact. Recessions historically mean more insurance claims, not fewer. So they needed higher rates to build reserves for that expected increase in payouts down the line.
Ah, okay. Anticipating higher future claims. That's a crucial point. What else?
Third, interest rates. They were at historic lows. Markel explicitly factors investment returns on their insurance float, the premiums they hold into their pricing models.
Right, the float.
So with lower returns expected from investments, they absolutely had to get more from the underwriting side, meaning higher prices, to hit their overall profit goals.
Okay, so falling rates elsewhere forced their hand on insurance pricing. And the 4th reason.
This was the big one, the fundamental necessity. Underwriting profits, they argued, are essential. Full stop. Essential for providing security to customers, essential for providing careers for their employees, essential for being a good corporate citizen, and essential for fulfilling their promise to shareholders to build value.
So it wasn't just a tactical move. It was tied directly to their core purpose and stakeholder responsibilities.
Exactly. It wasn't just about the numbers. It was about the long-term viability and integrity of the entire enterprise.
So if you had to boil down the lesson from that bold pricing move, what's the key takeaway for leaders in a crisis?
It's that conviction, the conviction that genuine long-term value means prioritizing the health of your core business, in their case, underwriting profit above almost everything else, even if it means short-term pain, like losing some premium volume.
Don't chase market share off a cliff.
Precisely. Protecting the core is the ultimate act of resilience. It ensures you'll be around for all your stakeholders tomorrow.
Which brings us back to that enduring Markel philosophy. The long-term perspective, the consistent mission statement and value system. And the proof seems to be in the pudding, right? Even after year like 2008.
Oh, absolutely. Look at their 20-year track record leading up to that point. 17% compound annual growth in book value per share.
Incredible.
And even in the 5 years, including 2008, their 10% CAGR smashed the S&P 500, which actually lost 1.5% over that same period.
And aligning actions with words, no executive bonuses in 2008.
Right. Clear alignment with shareholder experience in a tough year. They framed 2008 as a learning experience, emphasizing lessons about volatility, resilience, flexibility, and margin of safety. things they intended to apply going forward.
Now, there was this interesting discussion about accounting rules, specifically other than temporary impairment. That sounds technical, but why was it such a big deal for them?
Ah, yes, OTTI, as it's known.
Yeah.
It was a huge issue in 2008. The rule says if a security's market value drops below its cost, and that drop is deemed other than temporary, you have to charge it against earnings now.
Okay.
But Markel pointed out the massive ambiguity. What exactly is other than temporary? Especially when, as they put it, financial markets simply stopped functioning. Quoted market prices became almost meaningless as indicators of true estimated fair value.
They used an analogy, didn't they?
Yeah, a great one. The diamond. Its value at Tiffany's versus the price you'd get at a pawn shop in a panic. Same diamond, totally different context, wildly different price.
So for Markel, the market price wasn't necessarily the value.
Exactly. From their investment perspective, value means intrinsic value, what they believe the business is truly worth based on fundamentals. Impairment, to them, means the business itself has fundamentally deteriorated.
Not just that the stock price fell.
Right. A falling stock price could even be an opportunity to buy more if the underlying business is still sound. So while accounting rules force them to take some charges in 2008 earnings,
The OTTI charges.
yes, they explicitly stated they did not believe the underlying companies were actually impaired in the fundamental sense, and they planned to potentially increase their investments in many of them.
That's a really critical distinction. It highlights that tension, doesn't it, between sometimes arbitrary accounting rules and genuine long-term investment conviction, especially in a meltdown.
It's a huge dilemma for companies that think long-term.
Well, what a deep dive that was. Going through Markel's 2008 letter gives such incredible insight. Their transparency, their strategic agility, that unwavering long-term view, even facing down the barrel of the 2008 crisis.
It really does.
We've seen how they handled it. The disciplined underwriting, well, resilient investment approach despite the hits, and that proactive restructuring for the future.
Yeah, the key takeaways are pretty fundamental, aren't they? Operational discipline is paramount. Preserving capital matters. You need to adapt strategically, even when things are chaotic, and you absolutely must keep that long-term vision clear, even when the present looks bleak.
Their ability to see opportunity in what others call disaster is maybe the most powerful lesson.
I think so. That forward-looking stance, raising prices, restructuring proactively, it all points back to their unique Markel style and a deep commitment to it.
Okay, so here's a final thought for you, our listener, to chew on. Markel admitted that pure, unadulterated panic might have been the best short-term investment move in 2008. Yet their whole philosophy hinges on humility, measured steps, consistency. Given their incredible long-term success, what does that contradiction tell you about the tension between reacting to the market's noise and sticking to a disciplined, patient philosophy, and how might that shape your own thinking going forward?